So will there be a stock market crash in 2021, or are we going to continue to see a reflation rally? In this video, I discuss the current financial environment that could give us key clues. We also discuss the current situation with the pandemic and how that can affect the wider economy. We have a look at inflows we've seen with new IPOs, especially towards the end of the year. And we're going to have a look at the wider stock market, including the big tech names like Apple and their stock prices in terms of technical analysis, and finally finish on the S&P 500 and talk about the ending diagonal wedge pattern, which I had mentioned in the last video update. Hello everyone, it's Sajad again. I hope you're having a great weekend, so let's get started. We're going to talk first about current speculation in the stock market. By the way, if you're new to the channel, don't forget to subscribe and turn on your notifications. That way you'll get alerted to these regular stock market updates. Now, have a look at this chart. We're seeing at the moment record high speculation in the stock market. This is a 20-day moving average of call options traded. That's people betting on the market going up. And just have a look there in the last couple of months. We've seen a massive spike in call options traded. I've got here a chart. I'm just going to mark it off. So this put to call ratio for NASDAQ, and you can see where the level is at the moment. So we're hovering around the 0.45 level and the 0.50 level. So we're around the lows here, and this is a daily chart. Now, if the number is low here, like for example 0.4, what that basically means is there are a lot more call options being traded than puts. So a lot more people betting on the market actually going up even further from these kind of, you would say, arguably overinflated levels. So that's where we are at the moment. Let me just zoom out a little bit and just show you how significant that is. This is going back the last few years. And you can see here, we've not seen levels this low since way back in June 2015. Now, this is not a historic chart. This is only going back a few years, but you can see there how extreme things are. Just for sake of comparison, we saw the exact opposite here around the 12th of March. We saw a lot more put options when the stock market was actually crashing hard. Now, this chart here, this is the Goldman's US Financial Conditions Index. And what this is clearly illustrating is conditions for credit to stocks are looser than ever before. And this is a historic chart. So this actually goes back all the way to the early 1990s. So what does this mean? Well, easier financial conditions, as you can see here, they're good for growth in near term because they encourage borrowing, which I guess is the aim of the central banks. It also encourages spending by consumers, but longer term, they pose risks, which a lot of us are already aware of, potentially inflating bubbles in stock and other asset prices, enticing people to borrow more and take on more leverage. This was another interesting diagram I saw this week. This is a share of individuals who believe stocks will actually rise over the next 6 months. Now, this is more of an opinion poll, of course, but you can see there a massive spike. Note the last spike we saw around the beginning of 2018. Well, just before, it was towards November 2017. We're reaching those type of levels now. On the S&P 500, that would have coincided around a level here, around the beginning of 2018. And that's actually where we saw a reasonably significant peak in the stock market around the 2860 mark back then. So is this a contrarian indicator? Possibly. Let me know what you think in the comment section below. Current flows into US stock, mutual and exchange traded funds on a weekly basis. And you can see here, massive inflow, particularly over the last couple of weeks. Again, very high as compared to what we've seen over the past few years. Just be wary though of some of this data. We did have quadruple witching just this Friday gone. And for those of you that are new, it basically means it's one particular date where you get a simultaneous expiry of stock index futures, index options, and single stock futures, all expiring at the same time. What usually happens with this is you get a massive spike in volume. I wanted to show you this as well. So this is calls traded, and again the put to call ratio, but we're going back now to the early 2000s. It gives you a better idea of how extreme levels are at the moment. We're getting back to the levels we saw around the year 2000. That's in terms of the actual ratio itself, but in terms of overall volume, this year has been massive. The other thing of note is IPO ETFs also seen record weekly inflows. In fact, a lot of the new IPOs in the last few weeks, the new public offerings, the new kind of internet and other types of startups that have recently gone public, they've seen more gains in the first day than they ever have previously in history. So that's the state in terms of perception of the stock market, but what's actually happening, first of all, when it comes to the economy and the pandemic at the moment? Well, here in the UK, we're beginning fresh new lockdowns. So brand new tier 4 lockdown rules have been announced in certain areas. Again, I wouldn't be surprised if this actually spreads right through the UK in terms of lockdown rules. It's all very damaging, of course, for the economy, especially here locally in the UK and worldwide. But interestingly, even airlines have had enough now. So they're not actually even refunding customers who have already booked flights who can't, by law, who can't actually fly now. They're actually offering things like vouchers or exchanging flight dates only. And I'm not surprised, to be honest. The reason is, of course, this new identification of a variant strain. Now, how does this all relate to the stock market? Well, what we saw in the UK, very likely we're going to see in other Western countries if you haven't already, but we're seeing an extension of various different schemes. For example, our furlough scheme here was originally only supposed to be until the end of October, then it got extended to January, then March. Now it's been extended into April, and in a couple of months, who knows, it may be extended for the whole of 2021. That is very important because it's the government borrowing money, and this money is being funneled around the country, and this does absolutely devalue the currency, and it does push asset prices up. Now let's discuss where we are in terms of the wider stock market. And first of all, I wanted to discuss Apple. Now we talked about this a few weeks ago. It looked like we had a clear triangle wave 4 here, a structure, a sideways structure, consolidation, and now we were moving into a fifth wave. Now it seems to be panning out that way, and we should have higher highs to come in Apple. However, there is another interpretation of this. When we get onto the indices, the S&P and the Nasdaq in a minute, I'll show you why this is so important. But there is another way to look at this. We seem to be getting a lot of overlapping price action here. The other way potentially to look at this is we could get a very contracted final move up, an overlapping wedge move up higher. But as long as we break above those highs, that could be the end of a massive move from the March lows, and then we would expect a very significant correction downwards. Whole question is, how far and high could this final move go? It could end up going completely parabolic like we see in Tesla. The reason it's significant is because of what we're seeing in the S&P 500 especially, and the Dow Jones currently. So let me show you that now. Let's zoom in and let's go into a 4-hourly chart. So if we look at the entire move from the March lows, what we're seeing here after this sideways consolidation is we're seeing price wedge, as I mentioned in the last video. So let's have a look at this closer now. And by the way, just before I zoom in there, this upper trend line I've drawn are the highs we saw at the beginning of the year, so in February, and then another spike up we saw in November. So this kind of upper trend line here, which is where price is meeting a little bit of resistance. So let's just zoom into recent price action. So since the beginning of November, we had a strong move up and then we've gone sideways. Why is this significant? Well, let me show you again what I'm looking at here. So potentially it's this ending diagonal pattern. So the way it usually plays out, it doesn't show it really clear on this diagram. So let me just draw it for you. What I'm looking at is a 5-swing move where the first swing is quite strong, but then we get ever smaller moves. So the third is smaller than the first swing here, and then the final one is smaller still, and they approximate into a wedge. It's not perfect. Sometimes with the fifth wave will move a little bit higher, but that's what I'm just looking at here. Is that what's actually forming here? I'll give you an alternative in just a minute, but it's possible that's what we're actually beginning to see, and it may still be forming, so it may still be continuing. We are actually at all-time highs already, so it's possible it's completed, and I'm just drawing that on now. So this is one possible interpretation where technically 4 is smaller than 2, so this potentially does fit as a sideways ending diagonal wedge pattern, which has finished or will likely finish within kind of 24 to 48 hours at the beginning of the trading week, so before Christmas. Why is this so significant? Well, let me zoom out to show you why. If this is correct, then this is actually the end of the entire impulse move up. So we should expect a significant correction down. Now it's possible here is the end of the bull market entirely, the bull market that actually ran all the way from the early 2000s potentially. So we could be in for a very, very difficult time. I'm here on the Dow Jones futures on a daily chart, and you can see a similar type of thing. We're kind of sideways wedging there. So what is the other interpretation? Where the other interpretation was the original view I had in November, which is we are still gonna get a final strong impulse wave up to over the 4,000 area in the S&P 500. So how will that look now given recent price action? Well, another way to interpret this is the beginning of the third wave, a leading diagonal. So how will that look? It will be something like this. And the great thing about this, if this is playing out, we should see a lot more upside in the first kind of 3 to 6 months of 2021. Before then, we see a very, very significant top. So that could be anywhere over the 4,000 mark. And if price action does go that way, we'll keep an eye on it. You can see here on the NASDAQ, we're having the same issue here. Is this an ending pattern, or is this consolidation beginning of a massive rise? Very, very difficult to say for sure at the moment. But the great thing is with both of these kind of alternatives and structures, we should know the answer before Christmas. We should know in the first few trading sessions this week. Please let me know in the comment section below what you think. Is the market gonna take everybody by surprise early this week before Christmas? Or are we just gonna get a minor hiccup before a massive parabolic rally for the next 3 to 6 months? Thanks very much for listening.